Yeah, no. I guess questions. Well, it's because the stream went on, so we were on. We'd like to do 3 more minutes.
White potato, get with your forehead.
I'm not sure.
I like it.
Yeah.
I'm guessing you just.
Go ahead.
So yeah. I think it's well worth it.
Hey, Jay.
All right, it is my duty to get us started here. So I'm James Paul, I'm president of the Institute of Public Access Search and Success, TICAS. Thank you all for coming. I'm really excited about this event today. We think that income-driven repayment is really one of the most important aspects of our financial aid system. And we believe that student loans for most students is one of the best investments that they can make in their future. We know how important a college degree is and how valuable student loans are in making that possible for students. At the same time, we also know that there are some students for whom a college degree doesn't pay off, and it may be that they have a medical issue or they're unlucky in the job market. And so income-driven repayment allows us to say to students, no matter what, we can guarantee that this is a good investment for you. We are going to cap your student loan payments as a share of your income. And that's going to make sure that you can afford to repay your loans over time. TICAS has a very long history on these issues. In fact, we're very proud that in 2007, we wrote a report that laid the intellectual foundation for some of the policies that were enacted in 2008, and then over the course of the Obama administration, TICAS participated in helping shape what was called the pay and repay plans. And we think that there's been a lot of successes for all of these plans, such as student loan payments on income, collectively called income-driven repayment. We see now there are 7 million students enrolled in these plans, which is an incredible number. And they have an average income of about $36,000. And we have seen that it really has helped students both address debt aversion on the front end, and there's some promising evidence that it also makes a real difference in student loan repayment. So there's a paper that came out of Dan Herbst at Princeton studying specifically 15% of IDR, or the formula that sets your payments at 15% of income. And he found that being enrolled in that plan reduced delinquency rates from about 22% to close to 0. Also, very interestingly, he found some evidence that students need resources right after leaving college. And so he found that additional repayment flexibility matters for recent graduates, that there's a cash crunch, not just while you're enrolled, but soon after you enroll. And so students having the option of that IDR were actually had paid off more of their loan a couple of years down the line than students in the standard repayment plan. So we think there's a lot of potential here as a very powerful tool. At the same time, there's a lot of work left to be done. Most obviously, we have 1 million students a year still defaulting on their student loans. At one time, we thought that basing loan payments on income had the potential to completely cure defaults. We have too many plans. There are 5 different income-driven repayment plans. It's hard, even for those of us who are involved in creating some of those plans, to keep them all straight and the differences. We see burdens from the annual documentation requirements and benefits that could be better targeted on students who need them most. And then finally, this year, for the first year, is the year that some students will be paying taxes on the balance of their forgiven loans this month, last week, I guess. So we're very lucky to have a very knowledgeable panel here with a variety of perspectives on the path forward on income-driven repayment. I think we're going to surface a lot of different perspectives and hopefully learn a lot. So Before I turn it over to them, I would like to thank Senator Merkley and his staff for hosting this event and helping us get this room, and the Gates Foundation for the support that's allowed us to have this event. And with that, I'll turn things over to Colleen Campbell, who's going to introduce the panel. Colleen is the Associate Director for Post-Secondary Education at Center for American Progress. Previously worked at the Association of Community College Trustees and the Institute for Higher Education Policy, so she knows what she's talking about. And she attended multiple degrees from the great institution, the University of Michigan.
That's true. So welcome everybody today. I'll be your moderator. I'll introduce everyone on our panel, and then I'll have everybody give their remarks. Also, just a reminder that today we're being live streamed, so if you ask a question, there will be many more people than the ones in this room hearing your question. So my name is Colleen Campbell. I am the Associate Director at the Center for American Progress for our post-secondary education team, here with Diane Cheng at TICAS, Matt Chingos from the Urban Institute, and Chuck Neckley from Clemson University. So I'll let Diane get us started.
Thanks, Colleen, and thanks, James, and thanks to everyone who came today and everyone watching online. As Colleen mentioned, my name is Diane Cheng. I'm the Associate Research Director at the Institute for College Access and Success. We're an independent, nonprofit research and advocacy organization working to make college more available and affordable for people of all backgrounds. And we have focused in depth on IDR specifically for over a decade. And in that time, we have developed and continue to refine our own proposals for improving IDR and reviewed many proposals. And as James mentioned, we're involved in the development of the pay-as-you-earn and repay plans. And before delving into the details of our proposal, I want to first share the principles that we developed to guide our approach for designing and evaluating student loan repayment options. First and foremost, we consider the likely effects on college access, success, and affordability for financially needy students. We look at what unintended consequences can be anticipated and for whom. We consider the interests of different stakeholders, what evidence is available to support anticipated outcomes, and how changes can be implemented within and interact with our current higher education system, tax system, and social and economic conditions in this country. There's more details about our proposal in our report, which came out last year, called Make It Simple, Keep It Fair, a proposal to streamline and improve income-driven repayment of federal student loans. We brought some copies outside. I'm not sure if we brought enough, but this can be found online if you want any more detail about the IDR plan design features that we support and propose. First, we believe that all federal student loan borrowers deserve a clear choice between two streamlined repayment options. One fixed option where the repayment length is based on your loan balance, and one improved IDR plan. We think it's important to maintain a fixed repayment plan because IDR is not the best choice for everyone. Some borrowers prefer the consistency of making the same monthly payment throughout the life of their loan without needing to submit annual documentation, or can afford to repay over a shorter period of time to minimize interest charges. Also, for some borrowers, IDR payments can still prove unaffordable because of private student loan payments, healthcare costs, or other expenses that are not factored into the monthly payment formula for IDR. Additionally, requiring all borrowers to be in IDR, i.e. having it be the only plan, would have larger implications for college costs and affordability. IDR's promise of manageable loan payments after college must not relieve pressure on colleges, states, and the federal government to keep prices down and provide upfront grant aid to lower income students. We're already seeing an increased concentration of the cost of higher education on individual students and their families due to cuts in public support. There are real risks in defining college affordability just on the back end, looking only at loan repayment, rather than trying to reduce the cost of college in the first place, either directly through tuition costs or indirectly through need-based grant aid to lower income students. Having IDR as the only or default plan would also mean that we need to rethink our current accountability measures like cohort default rates. IDR is meant to be a safety net for struggling borrowers, not create a safe haven for schools that fail to serve their students well. Additionally, we have specific concerns about paycheck withholding as a way to collect student loan payments. When considering paycheck withholding, for many people, it's tempting to look at models in other countries like Australia and the UK but it's important to note some key differences in our higher education systems, social welfare policies, and tax systems that affect both how easily such a system could be set up in the United States and how different types of students would be affected. Notably, in Australia and the UK, maximum tuition is set centrally by the federal government, and almost all universities are public. As we all know, in our country, there's no national cap on tuition, and there are many more private colleges which tend to charge more. In terms of IDR policy, the income threshold at which borrowers are required to start making payments is much higher in other countries that have paycheck withholding. It's about $43,000 in Australia, and $35,000 in the UK, compared to about $18,000 in the US for a single person. There's also differences in tax structures, whether we have individual or joint filing, that can create unique complications around implementing paycheck withholding. And the strength of the social safety net can affect the likelihood of borrowers facing unexpected and high medical costs that can render even modest loan payments unaffordable. I also want to mention some logistical complications with implementing paycheck withholding that may undermine the goal of simplification, particularly for the most vulnerable borrowers, such as how to reconcile overpayments and underpayments, how to deal with borrowers who work at multiple jobs or earn income outside of the payroll system, how to hold employers accountable for sending the right payments on time, and how borrowers can still request deferments and forbearances if they still need short-term help. Borrowers have also, in focus groups, expressed privacy concerns about sharing their student debt information with their employers. And for more information about some of these logistical challenges, New America, Young Invincibles, and NASPA put out a detailed paper called Promise and Compromise a couple years ago that explores some of these issues in more depth. Also, it's important to remember that borrowers can already opt in to make automatic loan payments from their bank accounts and currently receive a small interest rate reduction for making payments in that way. We do support and propose changes that would accomplish some of the same goals that automatic IDR and paycheck withholding are trying to achieve, including automating the annual income recertification process and automatically enrolling severely delinquent borrowers in IDR. And there is a bipartisan bill that does this, the Simple Act. So I'm going to walk through some of the features of our improved IDR plan, some of the main ones, and there's more detail, again, in our report. First and foremost, it's important to have monthly payments be a manageable share of income and to have a light at the end of the tunnel so that borrowers are not burdened by loan payments until they die. Monthly payments shouldn't exceed 10% of discretionary income for low and moderate income borrowers, which is consistent with the calculation in the most recent existing IDR plans. For those borrowers, it's important to retain an income exclusion that recognizes that borrowers need to cover basic necessities like housing, food, and transportation before they're able to start making payments on their student loans. It's also critical to have a light at the end of the tunnel, and we have long recommended and continue to recommend forgiving student loans in IDR any remaining debt after 20 years of payments. One thing to note is that many borrowers in IDR will end up repaying their loans in full before receiving forgiveness due to the lengthening of their repayment period. For example, a single borrower with $30,000 of debt who earns $36,000 of income starting out would end up repaying in full under the newest plans, assuming some steady income growth over that period. So that means that the borrowers who receive forgiveness are those who have persistent low incomes relative to their debt. And that's an important thing to keep in mind when we think about targeting for this program. There are significant consequences for forcing borrowers to make payments for more than 20 years. Carrying that outstanding debt can affect borrowers' willingness and ability to make other financial commitments, such as buying a home or car, opening a small business, saving for their kids' education, or for their own retirement. It's also important for benefits in IDR to be targeted toward borrowers who need help the most. Low-income borrowers need a reliable safety net to help them avoid delinquency and default. High-income, high-debt borrowers, in contrast, shouldn't receive substantial loan forgiveness when they could have afforded to pay more. We recommend two specific targeting changes. First, removing the standard payment cap so that all borrowers are always making payments based on income instead of having a cap for higher income borrowers. We also propose gradually phasing out the income exclusion for borrowers with high incomes, such as those with incomes over $100,000. Those borrowers can afford to spend a larger share of their total income on student loan payments and still have sufficient funds to cover basic necessities. One important thing to keep in mind about targeting is that it should be based on borrowers' ability to pay. Some proposals and the existing repay plan extend repayment periods for borrowers based on whether they have even $1 of debt from graduate school. What people might not realize about this approach is that it's actually regressive and harms borrowers with the lowest incomes. This is because students with high enough earnings wouldn't be affected by a longer repayment period, because with their higher earnings, they have larger monthly payments and therefore would already repay in less than 20 years. It's the borrowers with continued low incomes for a long period of time who would pay the price of making additional years of payments. We also recommend that the annual recertification process in IDR be automatic. We should allow borrowers to consent to have the Department of Education automatically access their tax information. This change is often called multi-year consent and is incorporated in the bipartisan Simple Act, as well as the latest budget proposal from the administration. Department of Ed data from a few years ago showed that more than half of borrowers in IDR missed their annual payments to the annual deadline to recertify their income, which can lead to unaffordable spikes in monthly payments amounts, as well as interest capitalization. And new Department of Ed data that just came out a couple weeks ago also show high delinquency rates among borrowers in the repay plan who missed their recertification deadline and were moved into the alternative repayment plan. And finally, debt forgiven in IDR should not be subject to taxation. We had two handouts on the front desk about that. One walking through the tax consequences of debt being forgiven in IDR, and one is a printout of our blog post about how, for the first time, borrowers in IDR are facing this tax penalty. This has long been recognized as a looming threat for borrowers in IDR, and it just became real this year. We found out from the Department of Education that the first borrowers received forgiveness in IDR in late 2017, which means that their forgiven balances would be treated as income in the taxes they're submitting this year. Forgiven student debt is not a windfall of income. A borrower with $20,000 in remaining loan balance doesn't suddenly have $20,000 more in spending money when that debt is forgiven. And it's contrary to the policy goal of forgiveness, to have the government as lender forgive debt just to have the borrower move on to have the government as tax collector demand further payment from them. This will become a growing problem for struggling borrowers in years ahead and requires action from Congress to fix it. And finally, I just wanted to briefly mention that some of legislative proposals and existing IDR plans include some, but not all, of the changes we've outlined, including the Repay Plan, the Afford Act, and the Simple Act. Okay. First, I check.
Well, I drew the short straw, I haven't followed that, so I'll do my best. My name again is Chuck Nefley. I'm the enrollment manager at Clemson University, but my primary role today is I'm the chair-elect of a higher education loan coalition. And for those of you that may not be familiar, we're a grassroots organization of financial aid directors and enrollment managers who are very interested in protecting student loan and student loan policy for our students. I'm sitting next to some very intelligent colleagues who know a whole lot more about policy and the laws than I do. So, but I think what I bring and what our students and what our organization brings is that we sit in front of students. With the exception of 10 or 15 days I'm up here, I'm sitting in front of students and parents. And I think that's the perspective that I can bring and that I want to talk about today. I'll start with, there are two very important policies that Diane talked about that I want to emphasize, and that is eliminating the tax burden on forgiven debt. That's just, it's almost just one of those crazy policies that seems easier to get rid of than it has been. But we absolutely support that. We absolutely support having one income-driven repayment. I mean, if you look back and you follow the history, you can see why we have what we have. You can explain it all, but now's the time to fix that and put one in place so that we have two repayment plans out there. One that's income driven and one that's standard. We absolutely agree. I'm going to talk a little bit though about two areas where I don't know that we differ or that I differ with what Diane said, but maybe offer a little different idea on them. So when I thought about what I would say today, I thought about the basic idea. What problem does income-driven repayment, what's it trying to solve? And the answer that I came up with and my organization came up with is really three problems, or three issues. We're trying to make affordable payments for our students. We're trying to keep students out of default. We're trying to keep the issues and the policies as simple as possible. I cannot even begin to tell you how confusing it is. I do financial aid all the time, and I have to keep up on this. I can't even imagine what it's like for a borrower and for a student having to go through this, to be one of those 7 million and try to understand it. It is very difficult. So with that in mind, I want to revisit a couple of the issues talked about earlier. First of all is we're talking on a call before we came here about the terminology here, and that's default. So default has two words, right? You don't pay your loan, or the thing you get if you don't pick something else. So we're talking about both of them. We think you should default. Our group believes that we should default to the income-driven repayment plans, and not in its current stage, though. You're not going to know anything about repayment plans until you're ready to start repaying, and then you get stuck in one or two. So the coalition has a proposal, a white paper that talks a little bit about this. We really want to revamp the entire borrowing process, not the loans itself, but your loan debt and what you're borrowing should be presented to you every time you file the FAFSA. So here's where I get into a little bit of more detail. So a senior in high school, we'll just talk about traditional students. Senior in high school decides to go to college. They put 4 colleges on their FAFSA. The FAFSA comes back and says, here's what you can expect in a Pell Grant. We already do that. Here's what your school would offer you. We've already got that with the net price calculator. And here's how much you should expect to borrow. And by the way, if you continue for 4 years at this rate, here's how much you will have borrowed. And here's what your monthly payment will be under a couple of different plans. You put those scenarios in front of the student. So now we've got a student making an intelligent decision about where to go based on costs. They choose a school, they refile the next year, and the FAFSA pops up and says, you borrowed this much, you continue down this path, here's what you're going to owe under a 10-year, here's what you're going to owe under an IDR. We keep doing that until the student graduates. Now, when a student gets close to graduation, schools are required to do something called exit counseling. I think most people are familiar with that. We need to talk more about these two plans here and help the student make a decision. In fact, let them make a decision at this point. Now, with all of this education, if the student still hasn't chosen, then yes, we believe putting them in the income-driven repayment plan is the right move. For one, if they've really not paid attention that far along, we think that's probably going to be best for them. 2, I think there's a lot of evidence, James mentioned it in his opening remarks, that students are less likely to go into default from an income-driven repayment. And 3, although there is a chance, and I completely acknowledge this, that a student will pay more of the life of the loan. That is absolutely a possibility, in fact, maybe a likelihood. The reality is, if we get into the discussion about students not buying houses, not being able to buy cars, not being able to move out of mom and dad's basement, because of loan payments, this does address that, and that they'll have lower payments when they start and the payments ramp up, and they will have a little bit more money to work with so that we can move the economy along with those factors. So I'm sure we can talk about that again, but those are my thoughts. The second is that, again, we recognize all of the issues with collecting loan repayment by the IRS, payroll withholding, however you want to structure it. There are a lot of different ways to structure that. But if I get back to simple and keeping students out of default, the only true income-based repayment is one that goes up and down with a student's income. And the only way to do that is to link it back to payroll. Again, I will concede that there are some issues that have not been worked out here. But if we're really trying to link a payment to income, it seems as if that has to start with what the student is making. And it doesn't have to be for everybody. It could be an opt-in. It could be this percentage of the population works well with this one doesn't. I admit I don't understand the policy implications as well as my colleagues here, but it seems as if it's worth exploring if it does actually bring us income-driven. Thank you.
Well, thank you for the opportunity to be a part of the conversation today. Matt Shingas, Director of Education Policy Program at the Urban Institute. We are a nonpartisan research organization based here in Washington. So I think the kind of fundamental problem that we're going after here is that over the last few decades, we've asked college students and families to shoulder a lot more of the cost of college than we used to. And as a result, we're asking them to bear a lot more risk than we used to. Because, back in the day when you work your way through college and you walked uphill to college and snow both ways, in those days, if it didn't work out, if you went to a college that didn't work out for you, you graduated to a bad economy, you bore some of the risk of that, but you didn't have these loan payments that you have to make today. So the way I think about IDR is it's the obvious insurance mechanism to better protect people from these risks that we're heaping on them more and more than we used to. But the problem is that the insurance, it's not worth anything. It's useless to borrowers who don't know it exists or can't access it when they need it. So I think that there's a lot of kind of tinkering around the margins of the current system we could do to make it work better. But I think the best way to make IDR function well for insurance for everyone is to do something along the lines of what Chuck described, which is to make it the default option, not necessarily the only option. If you want to, right, if you come from money and you just want to write a big check when you graduate and pay it all off, no one ought to stop you from doing that. But it ought to be the default option. It ought to be what happens if you don't do anything. And the payments need to be automatic, not because it's inconvenient to go sign up for an auto debit from your checking account, but because it's important that they automatically adjust with your income. So right now, if you don't do anything, after you graduate, you don't make any payments, you end up in default. It's a bad outcome. Under a better designed system, if it's not the default option, it doesn't happen automatically. Same bad outcome is going to happen, right? You go to a for-profit college and pick up a couple credits or no credits and $50,000 in debt, and then you're like, I don't remember signing up for that. I don't remember signing up that paperwork, and you sort of ignore it all. You're going to end up in default, just as you do now. So I think really the kind of first best solution here is to, I agree with Diane that there are real practical challenges to implementing an Australia or England, UK style system here in the US in terms of our tax system. But I think that fundamentally we can deal with those. And while we're not going to get something that's perfect in every way, it's going to be a lot better than any alternative that we're going to come up with, where people's payments don't adjust automatically based on their income. Because under an automatic system, if you lose your job or have financial stress in your life, your income goes to zero, your payments go to zero. Your income goes to a low level, payments go to a low level. Under pretty much any other system where you have to go and tell someone that this happened, or wait for the IRS to automatically pull your tax records from that bad event, which is going to happen in like a year or so, it's not going to help you, and you're still going to end up in default. But at the same time, I don't see any movement in Congress, best I can tell, to adopt the sort of first best solution. So I think it also is worth thinking about and talking about second best approaches that can be improvements on the system we currently have and start to move us in the direction of what I think is ultimately a better system for borrowers. So I think these have already been addressed, so I'll just kind of remind you of a few of them briefly. One is to make the current system more automatic. For example, having your payments set based on tax data. You can eliminate the annual recertification. And once again, it doesn't solve the problem for a lot of people, but it would at least help some people who are currently, say, not recertified by recertifying on that. We could start pilot programs if we don't feel comfortable doing this for everybody at once. We can think about trying this on a voluntary basis, in states or some subset of borrowers. We can think about putting people into automatic IDR automatically. We're sort of doing this in a sense already. We're doing it a really bad way. Right? We're doing kind of wage garnishment in this very heavy-handed way. We're taking low-income people's earned income tax credits. Right? How screwed up is that? So I think we could move to something that is, we can acknowledge we already have an automatic system for some borrowers, and instead of having an automatic system that's punishing and harmful, we could have it be one that works better. So, now, I think it's important to acknowledge that if IDR is going to become more widespread, either through increased use of something that looks more like the current system, or due to a move to a more broad-based automatic system, we have to worry a lot about unintended consequences. And the first big one is the cost to taxpayers. And to deal with that, so there's one set of issues that Diane mentioned around eliminating subsidies delivered through the IDR system. people who don't need it. We want to give subsidies to people. We ought to do that on the front end. We ought to provide more Pell Grants. We want to provide targeted support to people to encourage them to go into public service. Let's provide grants. We want to go into public service. We ought to eliminate all these subsidies on the back end, such as the public service loan forgiveness program and other ways that high debt and relatively high income borrowers can get sort of windfall benefits through these programs. It's also really important to keep out bad institutions. I want to second Diane's point that IDR is not the solution to people who go to places that consistently have bad outcomes. It's the solution for those individuals as borrowers, but it's not the solution for the entire system. I mean, I don't want to see a world in which borrowers consistently go to places, have bad outcomes. They don't ever have to pay anything because it's IDR, but taxpayers are shoveling tons and tons of money to these places that aren't delivering anything of value for society and are wasting people's time and in a lot of cases wasting some of people's own money. So especially if we're going to move to an IDR system, on behalf of taxpayers, we need to do more to keep out the bad institutions and to kick out the bad ones that get in. And that's sort of a broader conversation I probably don't want to focus on too much today. But it's really important to keep in mind. And the last thing we have to worry about if we move more to IDR is price inflation. Secondly, another point that Diane made, which is that if we tell people it doesn't matter where you go, it's going to be fine. I mean, that's a good thing, right? We want people to understand that we don't want them to be too debt averse. We don't want people to borrow too little. But at the same time, we don't want them to think that I can just go wherever and spend whatever and it doesn't matter, I won't have to pay. And I think that basically the way we solve that is we need to tie how much you pay to how much you borrow. And I think one of the big problems of the current system in which you borrow $1,000, you pay 10% of your income. You borrow $10,000, you pay 10% of your income. You borrow $100,000, you pay 10% of your income. And that's crazy, right? There's a complete disconnect between how much debt you take on and what you ultimately end up paying. So if we're going to push more people into these income-driven repayment programs, which I think is a great idea, we need to tie how much you pay to the amount you borrow. So we could say, borrow $1,000, you pay 1%. You borrow $10,000, you pay 10%. Obviously, there has to be some limit, right? We can't take 150% of your income if you borrow $150,000. But we need to do this both for fairness reasons and to reduce this risk of price inflation, to make sure that people are still paying attention to how much they're paying. And it's not just an issue of, we want to make sure people pay. We also want the institutions to feel pressure to keep their prices from continuing to increase at rates that folks are concerned about. So the last thing I'll mention, if you want to kind of think about how the different parameters of IDR systems interact with each other, I want to do a kind of shameless plug for an Urban Institute tool we put out earlier this year, which is an income-driven repayment modeling tool where you can select your minimum payment, limit as a cap to the 10-year plan, the percentage of income paid, and see how that plays out for borrowers with different incomes in terms of how much they pay over time and how long they pay. That's something that'll be useful to folks who are thinking about kind of the more in the weeds design parameters of these systems, which are really important to get them right. Thank you.
Great, thanks everybody. I'll just give brief remarks and then open it up to questions from the audience. So get your brains rolling. I can use your hands ready to go up. So I just want to mention a couple of things that are present in the current system that are, I think, pretty significant stumbling blocks for borrowers that don't get a ton of attention as we're kind of looking forward into these policies. So the first is that under the standard plans now, I've heard a few people on the panel talk about having your monthly payment tied to the amount that you borrow. And that is absolutely important. I think the thing that we need to keep in mind right now is that when borrowers are defaulted into the standard repayment plan, when they go into repayment, they're required to pay a minimum of $50 a month. $50 a month is not an insignificant amount of money, but it's also an accelerated repayment plan for borrowers with low balances. They pay off faster than their 10 years that they're supposed to be allotted. And so I think that removing the $50 minimum payment for the standard plan is something that we really need to consider if we're going to be helping borrowers stay out of default. And I mentioned low balance borrowers because they're the second point that I want to make, in that most of the people that we see defaulting have lower balances. We're not seeing people with $100,000 defaulting on their loans at very high rates. Really, the people who are borrowing and defaulting are borrowing less than $10,000, and in most cases less than $5,000. These tend to be non-traditional students enrolling in community and for-profit colleges who go might be there for a semester or a year and drop out, and 50% of them is what we see defaulting in the data that we have now. I think that it's worth thinking about how IDR works for low balance borrowers. Is when you're thinking about tying the amount that you pay in IDR to your loan balance, what does that mean for someone who's low balance and low income? What does it mean to be in repayment for 20 years if you only borrowed $2,000, but you're so low income that you can't afford to make a payment? And so I would encourage people to think too, not only about, I think when we default to thinking about IDR, we start thinking about bachelor's degree recipients, graduate students who are borrowing tens of thousands of dollars, but really we need to look at kind of the population of people who are in trouble are people who are making payments and are struggling to make payments, but they're still kind of rolling through their repayment process. And we just think about people who go to school, leave, and almost immediately default. And those are kind of, I think, two separate policy problems that we need to think about if one IDR option is really the best way to address both of those populations. I also want to make a plug, which I don't think anybody has yet, that we need better data on student loan borrowers. You know, the information that we've gotten through NCDS sample surveys has been fantastic. We've now been able to look at kind of 12-year repayment outcomes for borrowers, but keeping in mind that those 12-year repayment outcomes don't really incorporate the period of time when we've had IDR in existence. And so we don't know what these long-term repayment outcomes look like for borrowers who have been using IDR since those plans were introduced in 2008, 2009. And so I think that, you know, we really need to take a look at some of the challenges that particularly face certain students of certain demographics, students of color, African American students in particular, who default at 3 times the rate of white students with bachelor's degrees. And we need to be thinking about, I wrote a column on student parents defaulting. About 25% of undergraduate defaulters are students who enrolled in college and had a child when they enrolled. And so we need to think about kind of the long-term repercussions that default has on these populations of borrowers. And in order to understand these long-term repercussions, we really need better data. And the amazing thing about this is that the Department of Education has all of these data. They just need to make it available to us. So with that, I will open it up to questions. When I call on you, if you could just speak loudly, I'll repeat your questions to the mic so that all the folks on the live stream can hear. But also, if you could say your name and organization, that'd be great. Yeah.
Jeff Harris with Duke University. In passing, a couple different things were mentioned, hoping you might be able to talk a little bit more about. Differences you might see in approaches to both graduate students as well as treatment of for-profit colleges. They seem to be a very traditional undergraduate 4-year focused conversation. You all have talked about how to treat those in respect to getting the bulk of your quote-unquote traditions.
Sure. So the question is how we should be treating graduate students and students who enroll in for-profit colleges as part of IDR plans. How should we think about those borrowers?
In our proposal for IDR, we don't propose different treatment for students from different types of schools. So students who attend for-profit colleges and enter IDR would have the same terms as everyone else. I think I wanted to underscore a point that Matt went into about accountability, that not just for for-profit colleges specifically, but for all colleges, it's important that when we think about changes to our loan repayment system, we think about ways that we're continuing to make sure that schools are leaving their students better off than they started. And we can't use loan repayment safety nets for students as a crutch for schools. And so that's not directly about for-profit colleges, but it is important to think about school quality because that has a big effect in how easily students can repay them. In terms of graduate students, they are currently allowed to repay their loans in IDR, and there is some concern about the amount that they might get forgiven, the amount of loan balances they're paying in IDR. That's what's led into some of the targeting proposals to target benefits in IDR just based on whether you have graduate debt. And I guess there's 2 things I would say about that. One is to the extent that concerns are about loan limits for Grad Plus programs, we suggest that they be dealt with separately and not try to adjust forgiveness and IDR for everyone, just to indirectly deal with Grad Plus borrowers. And the second thing that I wanted to mention is just because someone has borrowed for graduate school doesn't necessarily mean that they have a greater ability to pay than someone who has a quality undergraduate degree. People can have taken out $1 in graduate loans and not completed. People take out graduate loans to go into low-earning professions, such as teaching and social work. And so in thinking about targeting benefits, we are against just basing it on the type of loans that people have, but instead focus on their ability to pay and therefore stay on top of their payments and avoid delinquency and default.
You know, too much on the for-profit side. I mean, I agree. I don't see a reason why your the returns of your repayment should have anything to do with the kind of school you went to. On the grad students, I mean, I think it does, as I said, make sense to tie what you pay to how much you borrowed. And people who go to graduate school tend to borrow more, so I think you got to expect them to pay more on a monthly basis. And at some point, you probably also want to tie it to the period that you repay. Because as I talked about, someone borrows $1,000, we're not going to ask them to pay like 80% of their income, but maybe we'd ask them to pay it for a longer period of time. So both the percentage of your income and the period of repayment could be things that could be tied to how much you pay. And I agree with Diane. I don't think it makes sense to say, well, you have $1 for grad school, and now we have this weird discontinuity in the period of time that you pay for. And I also agree we need to take a hard look at the loan limits for grad students. The idea that you can borrow for any graduate program up to cost of attendance, including living expenses, which the sort of makes up. That seems kind of crazy to me. So on one hand, I think we need to take a hard look at that. And I worry about it more as maybe a political problem necessarily than a policy problem. You know, my understanding is that the graduate loan portfolio overall does pretty well. It's not like we're losing tons of money on it. I do worry that we're allowing people to maybe get themselves into situations they'll be concerned about because of borrowing too much for the smaller number of graduate programs that don't pay off. And then I guess I also worry we have all these people with these fancy graduate degrees and lots of student loan debt. Are they going to clamor for windfall benefits that would be after the fact and would be socially beneficial, but you know, they can become an interest group we have to worry about.
I won't talk for more than a minute because you summarized and actually agree on all fronts, except we don't make up those expenses. We have a very careful process about living expenses that we document really well. I would emphasize that I think we've covered this throughout, and that is, one, this is not a group that defaults on their loans very often. It is the students who stop out. So in some ways, it isn't even the problem population. Two, I don't think any of us would suggest that just because a school is for profit, it has any less of a track record, maybe the aggregate, but certainly not in the individual case. And three, I think what we're dealing with are much larger loan balances, and there were quite a few ideas that I won't recap, so we can cover that. But I think it's a great question.
Other questions? Yeah.
I think today with the American Association of Community Colleges, and comes out of the acknowledgement of complexities of dealing with, Diane, you outlined so well, of putting borrowers into an automatic sort of payroll deduction aspect of student loans. But just to push back a little bit on that without saying something that my association supports, is that what we do know, and Colleen outlined it very clearly, is that students default at the highest rates are the smallest balance borrowers. The students who, in much higher percentages, drop out of it and do not complete their programs. And they don't get into a repayment mode. So if you don't get them into the habit or practice of repaying or connected to their servicers or in some way engaged with the repayment system, then that is the reason why you're losing them. To some extent, there's a little bit of an aspect maybe of willingness to repay, desire to repay part of the students who didn't complete their studies. But I guess the question really is what do you do about, what can we do additionally about those students short of putting them automatically into a system that's going to draw from their resources, since we're acknowledging that in a substantial percentage of those cases, it's not a money issue for those students, certainly not if they're in IDR. It's something about their actual behavior of not, again, engaging with the servicers and proving what they are in fact able to pay. So I wonder if any of you have any response to that.
Okay, I'm going to try to summarize. So with the issue that David sees with low balance borrowers is that it's not that they are unable to repay in an IDR plan, it's just that they don't get into the habit of making payments on their loan. And so how would that lack of kind of behavioral influence have an effect on auto payroll withholding? Like what would the interaction look like between auto payroll withholding and building the habit of making payments?
So I have a few thoughts on that. First, I want to make a plug for what Colleen brought up, which is the need for better data on why these students are defaulting. Is it because they can't afford their monthly payment? Is it because they're not aware of repayment options? Is it because they don't think they need to? And I know there has been some research done, but there definitely could be more understood about a larger swath of borrowers, particularly more recent borrowers, and why they're defaulting. In terms of the problems of getting them into regular repayment, we do have two proposals for trying to improve that process. One is improvements to loan counseling. I think there are some things that are information problems and some things that are design problems, and this is a little bit of both. And to the extent we can make sure that borrowers are well informed about a clear choice between two streamlined repayment options, trying to simplify the landscape for them so that they know what they're choosing between and know the implications of that, that would help them. Specifically, I wanted to call out the fixed repayment option in our proposal is not a 10-year standard plan, but a fixed repayment plan where the repayment length is based on the amount we borrow, similar to consolidation standard plans. So it might probably, for certain borrowers, may not have the same monthly payment. We also recommend automatically enrolling severely delinquent borrowers in IDR, which would help borrowers who have low balances, didn't realize they needed to enter repayment, didn't realize they needed to start making payments. They would be automatically enrolled in IDR under our proposal. And the last thing I would say is I would want to know more, or I'm concerned about the unintended consequences for the borrowers that are low balance, not successfully entering repayment, and what the implications of paycheck withholdings would be for those borrowers. I'd want to know who they are. Are they, when we think about paycheck withholding, it does sound like it would be a very smooth, helpful process for people maybe like us who have regular paychecks, work one job throughout the year, but what if you have someone who's in the contingent workforce and they aren't making their payments because their payments fluctuate, they're a seasonal worker. Estimated taxes are already pretty complicated. Thinking about how to implement that for student loans, for vulnerable borrowers, just a lot of things to keep in mind. And so I'd say we want to know more about why these borrowers are defaulting and make sure that the solutions that we're proposing are actually both simplifying the process for them and improving their repayment outcomes and not causing any other issues with their lives and ability to cover other expenses.
I'll add one comment back to one of the things I mentioned earlier. When a student chooses not to repay, it's a I put my MBA hat on. It's a consumer choice that they're making, and they're assuming that the penalties for not paying out are not as high as if they were to pay. And back to entrance counseling, back to the coalition's idea to put more information about lending, borrowing onto the FAFSA. I'm guessing students that choose not to repay those small loans don't realize wage garnishment is going to follow, that it's not, you can't get rid of that loan in bankruptcy. There are some really evil things that happen when you don't pay your fellow student loans, and perhaps knowing that will keep more students out of that situation in the first place.
I had a second to call for better data, but I'm guessing we find that most folks who have small balances probably don't have big incomes and probably wouldn't pay anything. So I would see kind of eliminating the need to muck around with a servicer and prove yet again that they don't have very much money as sort of a
Yeah.
So in response to the last question, so you brought up default and specifically bankruptcy. So I'm curious about the thoughts that put on the table, how you think enrollment in IDR should interact with the concept of bankruptcy, and specifically should be paid, so how much?
So the question is, how should enrolling in IDR interact with bankruptcy, and how much weight should IDR be given when considering bankruptcy?
Yeah, I'll just a long pause here. I think this is something I've thought a whole lot about. I mean, my view is I don't see any reason why private loans should survive bankruptcy. I mean, they're just really form unsecured consumer credit. And but I guess you worry that people pay higher interest rates on private student loans, but people probably should take student loans. For federal loans, so it's a little tougher. I mean, I think that the challenging thing is that when you go through bankruptcy, like you have a car and a house, they sort of take all your assets, you know, sort of settle everything up, whereas they can't take away your degree. So I mean, I guess maybe just one observation, without taking a position on this, is that having a well-functioning IDR system, it makes you less concerned about the fact that the federal loan might survive bankruptcy, because if you're only paying as long as, you know, an affordable percentage of your income with appropriate protections and no weird minimum payments that aren't affordable, it's not like we're saying, okay, you're cleaning your slate except for this loan, and now you come out of bankruptcy and have this crazy high payment. By design of it.
Yeah, I would agree that increasing awareness and simplifying the process of getting in and keeping affordable payments in IDR can hopefully help some of these borrowers avoid needing to file for bankruptcy. But I did want to reiterate a point that I made earlier about the importance of having a fixed repayment plan, that even though generally the IDR formula is intended to provide an affordable monthly payment, there are a lot of things that are not in that payment calculation. If you have private student loan payments, if you have healthcare costs, you're taking care of your parents, lots of other expenses. And so there are some cases where an IDR payment still may not be affordable for a person. I don't know if bankruptcy would be the right route for them, but it's something to think about in terms of what RDR can promise and the types of students who may not benefit from it all the time.
Does anyone know about, like, you go to bankruptcy court, I guess. Do they then, like, help you get into IDR in your student loans? Do they know about IDR? It seems like maybe they could be helpful. I don't know.
My guess would be no.
Really?
I think our friends at NCLC probably help with that. Are there any other questions? Yeah.
Real quick, maybe Christina from Congressman Bureau Services Office. I wonder if you could just comment briefly about guarding against negative amortization as a policy option. Something I don't think we really talked about today. I'll do a real quick plug. My boss has a bill, Help Students Repay Act, that has that policy option as well as he simplifies it down to a standard repayment plan and one income-based plan. So can y'all talk about that as, you know, helping students repay?
Sure. So the question is, how can we guard against negative amortization in IDR plans?
Yeah, or just how that will help. Is that a good policy option to look at in regards to IDR?
Sure. Yeah. So basically, is that a good policy option in regards to IDR, considering negative amortization?
There actually is part of our proposal that I didn't have time to get to that does try to restrain ballooning balances for borrowers with low incomes relative to debt. There are a few ways to do it. We have supported what the repay plan does, which is cap the amount of unpaid accrued interest that is capitalized that you're accruing if you're a negative amortization. It currently has a different treatment for sub and unsub loans. Ideally, that would be somewhat simplified. But the idea being that if you are seeing your balance balloon, even though you're making payments, that can be very discouraging. I know there have been some focus groups and surveys where borrowers have expressed just a lot of concern about that. And it also is an even bigger concern if we don't fix the tax penalty on forgiven debt, because all of that accrued interest for the lowest income borrowers is treated as income on their taxes if and when it is forgiven at the end of their repayment period. So yes, we do think it is something that we should address in IDR, capping the growth of interest accrual for borrowers who are in negative amortization. Fixing the tax penalty will help with that, but it doesn't go the whole way in terms of the psychological burden of carrying that just continues to grow.
I'll add thanks to your boss. I think it's a great idea. The one other thing that the coalition's put out, and that is to consider not capitalizing interest at all. Again, trying to simplify it for the borrower. You can adjust for those costs that might be lost by doing that. But it just becomes much easier for the borrower to understand, and would also, I believe, would also address that issue.
Other questions?
So, sorry, can I
No,
just
sorry.
ask a thing? So if I was going to put my economist hat on, I would say negative amortization doesn't matter, right? The balance doesn't matter. You pay some percentage of your income for some period of time, and it matters because of the stupid tax thing, which needs to be fixed for lots of reasons. That among them, if you set that aside, it doesn't matter. But if I take my economist hat off, well, obviously, for a lot of people, it probably feels like it matters when they get their statement every month, and the balance is going up and up. So I think we kind of need to think about how to sort of reconcile this sort of psychological effect, and are there things that we would want to do to deal with it. I mean, one idea just to kind of throw out there would be is, well, if we're going to move to a system where lots of people, or maybe even everyone is, well, not everyone, but most people, as I proposed, would be in an automatic IDR plan, and the balance doesn't matter anymore, maybe we should try to move away from the idea of a well balance, and we should just say, well, you're borrowing some money from the government, but your repayment obligation isn't some balance. We're going to send you a statement with your balance. It's some percentage of your income for some period of time. That's functionally what we're doing. And we could even say, well, under the current deal you get is the taxpayers take all the risk when things don't go well, but you get to keep all the benefits if you do really well. Maybe we ought to have people pay a percentage of your income and have some cap on it, but have people who reap a lot of private rewards from their education, pay more back from the current deal.
Great, I think we have time for one more question.
Joe, on the Raven group, isn't it possible that one reason low balance people don't pay back is because they thought the education they got in various programs was worthless? And if so, shouldn't any form that enrolls them in an LDR program give them the opportunity to make complaints about the program that they entered, so that the government would have a better sense and better able to investigate profit or not-for-profit programs that simply are worthless?
Sure. So the question is, do low balance borrowers think low balance borrowers may not be repaying their loans because they think their education is worthless? And so on any kind of IDR application, should those borrowers note if they thought their education was worthless, so that the government could further investigate those programs?
There's already a process for that called borrower defense to repayment, which is separate from the repayment options, but is a defense that borrowers can raise. And so it's a form that borrowers fill out and submit to the Department of Education, and they have a process for adjudicating whether whether the borrower's school did defraud them, mistreat them, provide them misinformation. In that case, the loan would just be discharged. So it's completely separate from the repayment system, and I think it should stay that way. I can see a lot of unintended consequences to having a checkbox on a form about whether people think they should be paying back their loans. So there is a separate process, and there's ways that could be improved, but it's separate from IDR.
I'll add quickly that I think compounding that is that these students are often students who didn't complete a term or didn't complete a year, and the current process relies on the school to do most of the communication with the student. And when a student stops out like that, it is often difficult for us to go find them. So even if we had a more robust process or communicating the current process, it is often difficult to find the student to get them the information. But I absolutely agree with your sentiment.
Great, and I'm actually going to exercise my privilege as moderator to ask one final question. That's slightly tangential, but I think is very much relevant to this conversation. So I was on my way here in the morning, I was taking a Lyft, and my driver asked me what I was doing this morning, what we were talking about. And I said that we were talking about student loan repayment. And he said, oh yes, get rid of it. So my question is, why aren't we talking about just getting rid of all student loans? Why are we talking about IDR? Why aren't we talking about just total student loan forgiveness? Why do we think that IDR is kind of the best mechanism here?
Well, I have a lot of thoughts about that. One of the concerns about having total student loan forgiveness right now is that it gives the greatest benefits to people with the largest balances who may not have trouble paying back those balances. And so in thinking about being in a world where the government has finite resources to support people going to and through college, it doesn't seem like a fair or necessarily effective way to increase college access and success, particularly among students who need help the most. Even though I'm sure a lot of individuals would love that. But we do continue to support having forgiveness at the end of a repayment period in IDR, because that is different. As I've mentioned and try to reiterate, the people who are reaching the end of that window, who have been making payments for 20 years and still have a remaining balance, those are low income relative to debt borrowers, and those are the ones that we should be helping, not just anyone who has a loan, especially a large one.
Yeah, I was second to Anne's point. I mean, I've run some numbers indicating that the top quarter of the income distribution holds something like 40 or 50% of the outstanding student loan debt. So, you know, I think if you're going student loan debt might be a better deal for rich people than increasing tax payments. So if you want to do that, I think you could do that, but I don't know. A lot of people would think it's a good idea. And then again, the second point is maybe I'm just a little old fashioned, but I think if you borrow money and you have the ability to repay it, you should.
I'll take a slightly different direction, and I worked at 2 large publics, and I would say that step one in dealing with the high cost of higher education is to do something to put the pressure back on the states to reinvest what they've divested in that. We had loans 30 years ago. We did not have the need for income-driven repayment plans. I think it's mostly tied to the soaring costs. And I realize I've answered the public school, and there are plenty of schools that don't fall into that category, but I think it would be a good first step.
Great. Thanks for tolerating my YOLO question. So thank you everyone for coming today. This was really a productive conversation. I'll welcome James back up. Let's get some closing remarks.
I don't think I have much to add. I thought that was a terrific discussion. I really appreciate everyone taking the time to come talk about it. Obviously, these are critical questions. We have some 8 million students in default. The consequences are far-reaching. So efforts to improve these tools are really important. So with that, I'm going to thank our panelists.
See, that was really nice.